All right, what's up, everybody? Hello, welcome back. We are back in business. Although you are looking at my profile a little bit, so I do apologize on that count. Good to see everybody in the house. What's up to Swag? Just woke up from my nap, dude. I need a nap. Did anything happen? Yeah. It's a lot, man. You know, conferences, right? Talking all day. I mean, I'm a talker. I love, I do this, right? I was like, how am I gonna trade if I can't talk to people about it? Um, yeah, it's a bit, but it can take it out of you, especially in this like 19th century or whatever French lofted apartment or whatever that I'm in. That I failed to. Could have sworn I checked and saw whether it had air conditioning, but apparently not. And it does get warm, but it's good. Oh, I chart was weird. Second largest. Put OI was 25. Those going money. Do you think that weakens the stranglehold on to 24? Let me go take a look at that myself here. Let's take a look at the put positioning. Should be here. There's actually a lot at 21, weirdly. Yeah, that is a little bizarre, isn't it? To have that many at 25. Depends when those were entered into. But yeah, those all got assigned. So that corresponds to 1 million shares. Call look at this. This is why it didn't matter though. 23.5 had 12,000 contracts. 24 had over 28,000 contracts. 24.5, 15,000. 34,000 at 25, and then 13,000 for 26. Still a lot. Believe it or not, this week's OI still had 30,000 contracts at 30. It's just that the volatility, implied volatility, took the absolute piss out of these things. Oh, did we get slammed on the close? Of course we did. Of course we did. Kind of awesome for the calls, though. I sold more short calls into the close right before that, apparently. Should I close anything out? Oh, man, that's a massacre. Oh, that's a massacre. My, oh, my. Oh, whoa. Very interesting. Yeah, that took a lot out of. See, that's the thing is like I really wonder to what extent like that stuff gets done, right? We talked about this. Oh, there was a chance, in today's video that they might, move it up to juice some of the IV. I mean, IV weirdly, right, at like the composite value of like 60 is higher than what we've been seeing on a regular basis. So I guess they kind of already did juice that they decided to push that sucker and then sell some of the volatility anyway. It looks like today. But yeah, I told you I've been. I guess it's been a couple weeks since I mentioned this because we didn't really have a stream last week. But yeah, I've been kind of maintaining a sort of risk spread out. So a covered call spread. So multiple strikes, multiple expiries in kind of batches, and then kind of walk those out. Usually keep like a little bit of free shares in reserve in case we do get like a little IV pump. And then when I see that, it's like I can either throw those out there. If I know we're going to a weekend, I can just take some kind of low risk thing that's like a week out or 2 weeks, like for example, I'm like, all right, well, I want to keep these kind of mostly free, but I do want to take advantage of that sweet, sweet weekend charm. So I don't know, let me go ahead and sell 25, whatever, 27s for 2 weeks from now, or next week. I think I did that with like some of them today. So that's been going pretty well. And it has allowed me, I think, I have ended up taking probably some slightly riskier, a little bit more risky of assignment on some of the strikes that I would, than I would otherwise by doing this. I guess by keeping kind of some on the side, I'm not sure how much it evens out. But not displeased with the kind of weekly returns. What am I doing, I guess, per week, cent-wise, per contract? Is it 10? Might be higher than 10 cents. Yeah, it's not quite 20 cents. It's probably right now, it's probably averaging for July around 18 cents per contract, right? Per contract per week is more or less what I'm looking at for now. We'll see. It might go up once if I close some stuff prior to. I have also some stuff set for August OPEX and then September OPEX that I don't know. I mean, August OPEX is kind of fitting within the main group of the spread, and then the September ones are a little farther out. They're farther up too. They're up at 30, but those are down almost like 50% in like a week and a half in July. Like, is very interesting to see. So yeah, we'll think about that a little bit today. I know Richard's thinking about possibility of some volatility in August surrounding institutional filing deadlines. So maybe we'll look a little bit at that. But I got to do something with this stuff. You got to think, right? It's like it feels like we're kind of starting to get close, but I don't know. Yes, also high. Dude, Gamma Chad's the man. It's all about that gamma, dog. What's up, Michael? I like your name. We have good name. Shorts will have to cover if things go right. I'm not afraid of shorts. Let them short. RC already knows the inevitable outcome. Yeah, man. Oh, dude, the interview was tight, dude. That was awesome. He basically, look, for those who know, he came out and said what we've been thinking, right? The company is like, if somebody wants to give you $4.5 billion for foreign change, right? 4.2 something billion dollars for 7 years at 0% interest. Why would you not take that? You can sit on that and win. You can put it into treasuries and win. You're making free money off someone else's money for nothing. So, I mean, he pointed that out. And I think the media campaign this week was pretty cool. Just like kind of putting that stuff, like, we have $9 billion and no debt. Just putting that out there. We have $4.2 billion in interest-free cash. That's not ours, and somebody handed that to us. It's time to get the Boomy boys on board. I think is what that's aimed for. And like any of the questions that had to do with shorts or concerned about the mechanics underlying or fraud or bad actors, he's like, dude, how are you going to bad actor pure money? how do you bad actor a company into nothing that's 90% just money? Like, what are you going to do? You have to short the dollar is what you'd have to do to mess up GameStop. And if you do that too much, then that's, I mean, maybe that's like super like deep dimensional thinking. It's like, well, what if they get super desperate and short the dollar to drive the dollar down? But that's the Bitcoin play. If the dollar really gets shorted super high, Bitcoin just explodes. Yeah. Things that go bump in the night, dog. Things that go bump. What's up, Patizzle? You demand, my dude. Oh yeah, regarding conferences. Yeah. It's very good though. Energizing, but after a few days of doing it, you're just like, wait a second, wait, what? Sleep? What? Also, like, I don't know what they're putting in the coffee here, but it's like, pre-FDA Coca-Cola recipe. Like, I don't know. Just, it looks like it's just filter coffee, but that she gets you wired, dog. What's up, Diaper King? Diaper King. Let's see. Let's take a look, man. I mean, we could look at it from a gamma perspective. Although this isn't gonna. Yeah, we can do it sort of week by week here. Let's take a look. Kind of looks like more of the same. I'm not gonna lie, it like kind of looks more of the same on a week to week basis. But we got these 3 levels here. I don't know, man. Look, with a lot of this, it does. We would have to anticipate some sort of settlement buying, some sort of some kind of something coming in to move this. What is really interesting, in fact, we can go investigate and see if we got like more of those deep in the money puts right into the close. Is that what made us dip like super hard? Do we get these? We did get some today. 65s. Oh, they were just running all day. Like over 1,000 of them for 5 million in premium. They didn't especially spike into the day though. They were consistent into the end of the day, but they didn't spike. You can see, right? See, they didn't spike here. Don't know what did this. Let's take a look at those shares available to borrow. We got a little bit more of the 60s. Not too much, a couple hundred. None of the close either. So those are the puts that did that. Let's see. See if somebody borrowed a whole bunch. Like 200K. But yeah, okay. 200K could have done that because volume was, what was the daily volume? It's pretty chill. Volume was 6.5 million overall. So let's see what the off exchange was. 63%, 4 million. So our true volume for today was 2.5 million. Less than 2.5 million, which is very low. Which means that yeah, those 200,000 shares would have represented 10% of the total daily lit exchange volume. So yeah, that would have caused a little 20, 30 cent move like that. Yeah, for sure. Somebody direct shorted that within the last hour is what that was. But kind of back to this question of what things look like going in the next couple of weeks. Yeah, I mean, we need something to come in and move us up here. This is pretty tightly clustered. We'll need to get an update kind of going into next week. Gamma values are going to adjust, obviously, once the weekend is done. And we get a kind of update on price kind of going into the open market. I mean, if we get into here, if something moves us through here, there will be a lot of hedging. Like there will be a lot of hedging, and IV will kick up noticeably because look at how tightly clustered all of this gamma is. But if we don't move up through that, then we stay at 2350 all week, and 23 is such a big, what is likely mostly a short put position, keeps us from going below 23. So this is why, in part, our volatility is so low. Whoever is interested does not want the price. I guess who's ever maybe using these puts to maybe control the price action, maybe using a little bit of shorting, does not want the price to go up into this very, very dense bracket of gamma, like 24, 24.50, and 25. If we look at the OI, probably got more added here. It's not as much as an OPEX. 25's got close to 20K contracts, 7.28. A bunch is going to get rolled, right? A bunch is going to get rolled into here. So these are probably going to pop over 10,000. That's going to pop over 20. And then on the put side, down at 23, it's only 4,000. It looks way more. It's shifted way more in that area, but I guess we have a slight bid skew, but not tremendous. So for next week, I don't know. I don't think we're anticipating anything settlement-wise. FOMC, not yet. 8-1. Probably just not even that much OI for 8-1 yet. Yeah, like people are not selling weeklies out that much. 8-8 is probably even sparser. Yeah, there's nothing here on 8-8. Yeah. August OPEX. A lot of 25s. A lot of 25s. Oh, 30s. I could sell some 25s. Oh, why don't I want to sell 25s. Somebody did a bunch selling it right into the close. That's funny. Oh, right before we dumped, too. That's funny. 2K. That's funny. So, I mean, options-wise, it doesn't really look like we should expect. Really, I mean, it looks like more of the same, really, even into August OPEX. For now, I mean, maybe stuff changes. But yeah. Yeah. That's tough, man. Yeah, that's why I don't. Yeah, I did not go long calls this time around coming out of this dip, just because was very uncertain about the down cycle, and we're getting what I thought might be implied by that, right? In the sense of, okay, well, we're doing the bond offering again, but now we just did a bond offering into an off cycle. And so we bounced to 2450, and then we just kind of fell back down here like a cold hockey puck. I don't know. So I log all my trades in TraderView. So TraderView, TraderVue. I think if you like click my links, my link tree, I have like a link to the page. Like if you want to try it out, try out the free version first. If you like it, if you want to try out some of the more advanced analytics, like there's a discount code or whatever there. But if you don't like test out the free version first if you think it can be useful for your trades. See if you like it. It can be really useful. I use it because it integrates really well with Thinkorswim. So I just export trade activity files, and then it gives me some pretty decent reports. Otherwise, yeah, I just kind of brain it, which is probably not the best way to do it, but yeah, I mean, I hate to say this, but sometimes, a lot of the time, I'll just enter stuff, or I'll just buy, or I'll just sell stuff. I don't buy calls on impulse, right? I don't impulse buy long options, but I wouldn't even call it an impulse. At this point, it's kind of intuition, in the sense of, I don't just mean, I felt like it. I think I've looked at this stock and these, like, these signals, data sources, whatever, that there's some deep pattern recognition thing in my brain that, like, I can't quite articulate. But if I'm looking at the tape, sometimes it just goes like, oh, now, and I can't tell you ahead of the time what that looks like beyond what I already, talked to you guys about. But sometimes it doesn't even make sense. It doesn't, like, like, I can't go into the day being like, oh, this is going to happen, and I'll sell calls when it does. It's sort of, like the other day when I kind of saw, last week, we got one of those kind of vertical ups, kind of those right angle price action moves. I closed a bunch of, like, for no reason, I closed a bunch of short calls immediately before that. And then I messaged a couple of people. I was like, is it going to go up now? Like, I think I messaged Richard that or something. I was like, it seems like it's going to go up, like, right now. And then 2 minutes later, it went like that. And then I just sold all my calls again off the top of that. Could be luck, but sometimes I just have, like, a feeling about it. And I think part of that comes with just, if you stare at the charts, if you stare at the same stock's chart long enough, part of your brain can kind of internalize what these moments look like. And as long as you are properly matching the right, probability instrument to that situation, then it'll work out for you. So, like, selling short calls, picking the right strike. That's the other thing. I don't sell. Here's another trick, right? I'll tell you guys too. When I sell, when I pick strikes to sell, I will stick to certain. Like, I won't sell 23s, for example, even though sometimes that would increase my profitability. That might work super well. But the thing about, say, like $23 is, I know there's nothing special. There's nothing structural about that price level. A week out, 2 weeks out, a month out, a quarter out, a year out on the technicals, There's nothing special about that. There's nothing special about that level. But 25 is one of those strikes where we have a high accumulation of GEX, we have a high accumulation of call OI, and for whatever reason, that strike does not gently yield to these kind of, as I've talked about, these kind of bracket shifts, these sort of macro bracket shifts. So over the past year, right, when we get into the 22 to 25 bracket, it takes like a cyclical shift, a cycle shift for us to get out of that bracket. And something about $25, it's like longer than you think it would, stays out of the money. So when I also say impulse or like these intuition things where I see these moments, I kind of, get a spidey sense tingling or something looking at the chart. I'm also making sure I'm picking strikes that are kind of shielded by these grooves, like, in our like bracket structure, which I think is likely related. This is at least my hypothesis and the theory I've been running on for the past, year plus now, is that it's likely related to how, the dealer book is positioned, how the market maker is exposed, and how the market maker is hedging that exposure, weeks, months out, and it, conforms to these positions. So, I don't, depending on how far out I'm going, it's like, okay, I sold September 30s. Why? Because I'm pretty sure that's still going to work out. Now, I may reposition. I'm not going to say, hey, everybody go out, sell 30s. I'm not saying that. But a couple weeks ago when I did do that, I was like, I got at least 2 weeks to burn here, right? Because this is not going beyond 25 for July OPEX. It's probably not going beyond the week after July OPEX. August 1st, it's still probably not going beyond that. Maybe we get something going into August OPEX. Maybe. But also decent chance no. So I've got 2 to 6 weeks to burn out of these things. And then on the other side of that, are we closing above 30 prior to earnings? I don't think so. Maybe I'm wrong, right? I don't know that. But there's something kind of internalized there after watching this thing so closely for so long that kind of tells me like, that's probably a pretty safe bet for an off cycle this far out from earnings. So, but check out Trader View. Check out the link on my links. Play around with the free version. If you like, I think there is, if you want to try out any of the more advanced kind of analytic stuff, there's a discount code there that you can put in. But really try to spend some time with the free version first to make sure it can benefit you, is what I'll say there. What's up, Sergs? How's it going, man? Oh, what's up, Sharon? Welcome, my friend. Hello, I worked my portfolio in crypto stocks to build more cash and had more luck. They're wanting to straight buy, not options, GME before earning. What's the forecast lows? Do we go lower, huh? I mean, I don't know if we go down more from here. I don't know. Maybe if we get this kind of market capitulation in a little bit, this kind of correction, I should say, maybe we go down a little bit. If we take a look at our chart here. I mean, do we go bounce off this deep low again? 2150? I don't know. I don't think so. I mean, what do I know is number one. I suppose, right, that's not something I guess I can know. And so when I get into these situations, of course, then I I approach this probabilistically and from a risk management perspective. So because I would say, right, I say, all right, how much more maximum downside is there? And I don't see this going below 2150. I don't see this going below 2154. We didn't on the last go around, right? With that huge mega shorting coming off of the second bond offering. We didn't. We won't drift below there, I think. Do we get a Fed cuts rates, people panic, sell off? I don't know. That also doesn't quite make sense to me. So, I mean, I would say that from where we are right now, we've got kind of like maximum, hypothetically, like less than $2 of downside. All right. So with my covered call strategy, I'm looking at ideally, I say averaging $1 a month. These are slower months with lower IV. So, like I said, I think for July right now, I'm averaging across the spread, across my whole spread, I'm averaging like 18 cents per week of closed profit, which over the course of July will come to like 75 cents, 70 to 75 cents, probably closer to 70, after fees, maybe 68 because the volume's been pretty decent on my end. So, okay. But then, all right. So I say, all right, buy at 23.30 or something like that, less than a dollar, less than $2 a downside. Worst case scenario, I, go ahead and, I sell these. I take profit out of those shares that I buy at 23.50. And that cash that I take out of those shares by going ahead and selling calls, I then also go ahead and roll into new shares and sell covered calls on those. So, to a certain extent, right, the risk is mitigated within 2 months. So not, buying the shares as I have, basically continuing to buy in the kind of low 23s since, later June, mid to late June. I mean, bought on the initial move to 2150, kept buying, bought a little more in the 22s, end of June, bought a little in the 23s, early July, mid 23s. Now we're kind of back down here buying in the 2330s, 2320s. Yeah, like, sure, there is kind of surrendering that kind of maximal downside, but that's mitigated by the fact that I can sell options on top of that. So, if we do go down within a month, that's essentially immaterial. I will have sold by not waiting with the cash, by going ahead and just rolling it into shares immediately and then selling covered calls on top of that. It didn't immaterial, same result or slightly better. If we never go down, then by selling covered calls on top of those shares and buying when I did, not only did I buy the best price, did I get the actual best market value, like market price in that whole span of time on all those shares. But then I also was able to, essentially amortize a part of that share position by selling covered calls on those shares the entire time. And, got a price that wasn't available, essentially de facto, got a price that wasn't available on the market for those shares. So that's basically how I approach that situation, Sharon. Oh, nice. That's probably going to go pretty well for you, man. I would imagine. It may not, depending on when IV comes back, you may kind of see it go, depending on how much time that is, right? It may appreciate, it may not depreciate at the same rate that you might expect based on the return of volatility, depending on how much it comes back. But that's probably still gonna come back in your favor. Let's see, what do those go for today? Oh, if you sold it on that dip too, that was nice. 23 put. Oh, beautiful. Yeah, bid ask spread on that was 254, 275. So, oh my gosh. Yeah. So if you're getting that, you're getting those shares at, if you get, even if you get assigned, right, you're getting those shares at almost $21, basically below. That's the same concept that I just talked about, right? You can do that too. You're getting those shares at below any available market value price since March, early April. So cool, man. Nice. For sure, for sure. Yeah, you can roll them too. That's right. Let's see, Anton. I was thinking today, if all these bond buyers are just selling options to profit from IV, then wouldn't having more bond buyers and more options being sold actually crush IV? Are they? I don't know how their trade works. I guess I guess they could be selling options as well. Maybe using options to hedge their position, using the bonds as collateral, right? Possible. Yeah, we're off cycle, so Richard has a very good theory for this. I'll say that seems quite likely. So you might have to say, right, what causes a change or a movement in the stock at all? We know that in these circumstances it's not retail, because that's going to get orders just get filled at the mid by equities market makers. Doesn't even Our orders do not hit the lit market. They get settled. They get bought actually and settled. Who knows when? Whenever they want. Very large options volume can stimulate hedging and move the price, which we've seen. Why that would happen is usually tied to something that has to do with settlement. So when we are essentially trading at something like fair market value, which we are, right? We are trading at Morningstar fair market value right now. How that has changed, right, and what the future value of the company is, of course, that's up for debate. Because we're in this position, institutions are likely accumulating, and they likely understand that Ryan Cohen just has to kind of not fuck up, right? Like this is a slam dunk. Earnings is going to be good. Fair market value will change soon, but that's the present data, right? That's the present estimate. That's the present consensus. So this is fair market value. When fair market value changes, or when the institutions that are pricing the stock are positioned to be able to take advantage from fundamental changes in the company, from increase in profitability, right? Then they will allow the price of the stock to go up, and they will allow the price of the stock to go up in part, yes, because it will be profitable to them, but two, because they may also be at risk of the situation being possibly, not gainful for them. That's another one. Not just that they could profit from the situation, but that they could lose from the situation. And Richard has a very good theory pointing to recaps. So this is where any unsettled trades that sit in the obligations warehouse are repriced. So if you needed to settle a trade that took place at $37, you got an order can't come in that says, I'll buy at 37. Could be a retail trader, could be something hedging options wise, whatever it is. You go, okay, well, I know this thing is going down. So even though I don't have this share, because I'm engaged in bona fide market making activities, I can sell a share that I don't have and figure it out later. Then I can go ahead and I can do this whole, settlement thing and just kind of be like, well, really, if you look at these rules for normal settlement, it's something like settlement must occur at T+1. If not, then T+3. If not, then T+6. If not, then T+35. If not, then T+70. If not, then with special dispensation, 60 calendar days later. If not, then a special letter with special permission says that, whenever. That's what it ultimately boils down to, right? That's what it ultimately boils down to. Now, different participants have different strictures. If you're not a market maker, you can't do everything forever and daisy chain everything. You can't do it like that. But for market makers, maybe prime brokerages, stuff like that, yeah, you can. Hey, can I have that super special letter, please? Okay. So, but there is an element to it, right? And it's that settlement thing, it's still going to be marked. It's still going to be flagged as an unsettled trade. And it's going to go sit in the obligations warehouse. Now, every couple of weeks, we have recaps. Recaps is when the price of those trades are adjusted. So let's say, whatever the price of the underlying is, however that was processed, let's say your $37 share, right? You go, well, I don't want to close this trade. Let's just, whatever, I'll close it later because I'll wait until it goes down. Well, you go, well, I don't want to use it yet because I like having this extra cash. There are things I want to do with it. I want to, have liquidity elsewhere. So, okay, what? GameStop's going to be at $23 for 2 months? Fine. I've got 2 months to close that trade back in late May. That was for 37. Let me figure out this stuff that's going on with SPY, right? Let me stay liquid for that. I want to distribute into that, right? I want to make sure that my positions there can be unwound and repositioned, etc. And I want to have this cash on hand to have liquidity for that type of trade. So I'll buy GameStop when I'm done with that. And it's not going anywhere. It's staying at 23 forever. I just don't want it to go back up above 37, right? And okay, for 37, they could just wait for a really long time for that, probably, right? But what about those trades at 27 or 25 or 24? What happens when GME starts to price up because increased options volume, maybe something to do with earnings, maybe something to do with interest rate stuff? If there ends up being a price up with recaps and there are unsettled trades that are getting close to being at risk of being unprofitable, and even more unprofitable the longer they remain unsettled, then it's time to actually get those things out of the obligations warehouse, right, and close them. And the way that you do that is just by punching in a VWAP order. And that sends the price up. Okay. What brings the price down? Well, selling, right? Like selling things you don't have. Rerouting lit volume off exchange. High demand for shorting and lending and borrowing of shares that don't exist. Facilitating short trades with shares you don't have. Doing all this stuff. And over time, seeing the price get adjusted. Okay. What then determines at either extreme or, throughout this process, what bounds trading along certain price ranges? That's going to be market maker hedging. That's going to be options hedging. And that's going to influence how tight, let's say, of a range we'll trade in, and also sort of provide values for the Black-Scholes-Merton calculation for how, yes, the options should be priced, but then how they should be priced going out, right? It's going to provide information for what the expected move is going however many weeks out. Yeah. So why is IV low now? Well, the price of the stock has been adjusted downward. There is not an upcoming earnings period. There is not a bunch of internalized settlement stuff that needs to be cleared because probably not a lot of stuff was internalized on this down cycle. It went very quickly, and the whole thing ended up being kind of a giant money transfer to the company, right? So why is IV so low? Well, our options positioning makes it such that hedging basically has us stuck in this tight little bracket. We just go sideways. Volume is very low. And the more days we have low volume in a row, and the more days we have this tight trading range in a row, the less realized volatility we have, and the less going forward that IV calculation is going to say, oh, it's likely that the price will move a certain amount in the 30 days going forward. We don't have an earnings 30 days out from now. We got to wait almost 2 months still. I think 7 weeks ish, thereabouts. So all that stuff ends up keeping IV pretty low right now. Hopefully that answers your question. They are. That's very funny. That's a good joke. That's a good joke. Yeah, that's a good deal. Hey, what's up, Tom? Cannon Fodder, great name. What's up? What's up, Heather? Let's see. What's Heather got here? Why the interviews now? Makes you wonder. Maybe a big dip is coming, and this was his way of letting us know everything good. It's good, and he's not worried. Big dip? Why would you think a big dip? I mean, maybe, but why do you think so, is my question. Maybe, because I don't know, but maybe you do. Mm-hmm. There probably was some distribution. Why haven't we rebounded? Well, we did, but again, so going back, I mean, I understand you also posed this question prior to me giving that very long response. But if we go ahead and look at our chart here, what sent us right in this April-June cycle here, what sent us back up here, right? What brought this about was de-internalizing all of the stuff that wasn't settled in here. Everything that had to be, that was internalized back here, had to be de-internalized here. Okay. Nothing had to be internalized, or very little. Maybe some of it was internalized up here, but comparatively, compared to this, it was not required, right, in order to adjust us down. This was not like our move down from this pop up here going into earnings was a reaction to earnings. This was not de-internalization of this volatility. This was de-internalization of this volatility. So the last bond offering did not countered earnings, but not this volatility de-internalization here. This move did not so much counter an earnings pump. This earnings move was essentially front run. So this was sold off. The Bitcoin pump was sold off prior to the bond offering. And so the bond offering adjusted the price downward without any kind of large internalization cycle for several months prior to it. So there isn't something on the mechanical side of things to bring us back up right now, is the thing. So we have to wait for something like interest rate change, which is going to cause swap repositioning, which is going to cause hedging repositioning at those really high level derivatives with prime brokerages and the interest rate swaps that prime brokers have with major hedge funds, like we saw during the November-December cycle last year. Like I said, we also are not close to an earnings period. If earnings knocks it out of the park, that'll be a thing, right? That'll be that could do something. But we don't have any of that, and we don't have any de-internalization right now. So that's why we did rebound, right? We rebounded from 21 something to 24 something, but not into the 30s. That was probably kind of purely hedging and options stuff that caused that. That's my guess. But we'll probably have to wait until late August. Well, this is sort of the other point, and Richard brought this up too. We will have institutional filing around August OPEX. We'll see about an interest rate change on July 30th. I think the expected move is none. Let me just bring up FedWatch real quick. Oof. Sleepy. My apologies. Where is it? There it is. Yeah. Less than a 5% chance is what is estimated. How's a cut in September? Odds of a cut in September, though, are over 50%. They are over 60%, actually. So if we don't get one in July, they're basically saying like, oh, we're gonna get one in September. But we'll probably have to wait for Fed forward guidance to figure that out. Yeah. Maybe we'll have a new Fed chair. Who knows? What's up, dog? Hey, man, whatever works for you. Pen and paper works for you. Why not? I'm sure somebody did it that way at some point. That's a good question. I don't know why we can't see the second group of bonds. Well, cheers, man. Yeah, I guess that's what I settled on. That's not how I started when I started trading. What, almost 5 years ago? No, yeah, more than 5 years ago. That's not how I started. But once I messed up a bunch, I figured it out. Yeah. So, I mean, why do this trade? You are locking the money, but let's say that you. So right, I told you a pretty good average target. What I sort of make for my average target, in in options, is I shoot for $1. I shoot for $1 a month. I want to average. My goal is to average $1 in options premium per month. Very doable. That's essentially what I did last year, right? So I mean, it went up and down, and I also had some kind of bonehead trades that I actually would have been better, right? If I didn't make some of these more experimental trades. Also, early on, I was really super risk averse when I was kind of piloting some of this stuff, and I was like, oh my gosh, Roaring Kitty could come back at any moment and explode everything, and then that didn't happen in July or August, right? So so it ended up being about $1. Probably, a more skilled or experienced trader could push $1.50, $2 per month over this, maybe even more, right? Without flipping the position, right? Just doing contracts. But somehow me being, not a professional trader, not having training, just kind of figuring this out as I go along, with the help of many people, of course, online, was able to average $1 per month, selling mostly covered calls, but some cash secured puts too. If we do this out, right? So he's locking up 2,300. He would lock up 2,300 if he bought the shares. And let's say he sold, the mid of that at like 265. So we have, let's say, 2 weeks left in July. We've got 4 in August, 4 in September. So now we're at 10. So 2.5 months. And then, right, 4 in September, and then 3 in October. Okay. If those close at 2301, so that's what? That's 3 months, 3.1, like 3.25 months. So an ideal amount for that, let's say, would be something like 3.25, right? $3.25 for the contract would be ideal and would hit that kind of target average. Keeping in mind, of course, that we're in very low IV territory. Plus, he's only locking up 2,300. He's not locking up 23 and change. We haven't seen 23 even in a while. All right. So he's got a decaying instrument that's getting him pretty close to what I would consider like that's what my monthly target is with that. Not quite, but close. He's also picking up, if he sold one, he's getting that cash now, right? So he's getting that 275 or 265 or whatever in his pocket now. So I get he's going to collect a little bit of, interest rate on that. He's going to collect 3 months of interest rate. So like 1%. So he'll collect, not much, right? $2.65, something like that. Maybe $3. But okay, factor that in. That'll offset his costs for selling the contract, something like that. And then what can he do with that 265? If he wants, he can go buy, 10 shares, 11 shares. And if he wants to swing trade him, he can do that. Right? So if his put expires worthless and the price, really goes up and it goes to whatever, 26 or 27, he's getting another $70 on top of that. If he wants to sell those 11 shares, at $26, 3 per. If he bought at 23, $3 a share, 33, put that on top of the 265. And now he's pretty close to his $1 target, right? He's 25 cents off. Ballparking it. So, right, that's how to, okay, why am I walking through that? That's how I'm thinking about these trades, okay? Now, is it a supreme deal? Is it crazy? Like, back when we were about to, we were running into the Bitcoin thing? No. Was it, or on that bull run? Oh my gosh, a month out, I'm getting $3 per contract on a $30 call short, on a $35 call short? What? No. But those were very different circumstances. Maybe he'll decide he wants to reposition. If that decays 50% into, the end of August, maybe he'll go like, all right, that's fine. I'll close that. Let's watch our IV go up. And then I'll do another one. Or I'll buy shares now with the money. Keep the overhead. I'll buy shares with the money now. That 2,300 or whatever. Maybe the price stays like 2,350 or something. And now I'm going to hold these shares. Price is going to go up into earnings. And then now I'm going to sell all on the top of that with a long instrument with the delta appreciation. He could do that. That's how you want to think of this. At least that's how I think of my trades, and that's what I aim for, right? I do not trade to make myself as rich as humanly possible, to have as much money as humanly possible. That's not in the shortest amount of time possible. That's not what I'm doing, right? I'm not min-maxing ridiculously. I'm not, right? This is why I'm not a professional trader. This is why I'm not working in a financial institute, because that's not why I'm not working for a prop trading firm or trying to push stuff on this or take more complicated extra leverage option strategies, because that's not what I'm trying to do. I think what I was able to do over the past year, I'm trying to replicate that in terms of what I'm averaging on cover call premiums, short options premiums per month. So if he's got a similar target with that trade, he's essentially doing that. Now he's doing that with a different instrument than I am currently doing it with. But gets him essentially to the same target. Now, of course, his risk is in there's potentially opportunity cost loss. If GME takes off, his upside is capped. But I mean, it's capped with the covered call too. It's just capped maybe a little higher with the covered call, because I'd be assigned at higher prices, right? Whereas his contract would be like being assigned if he bought at 23. It'd be like being assigned at 25.65. So But you see how that works, right? Do you see why somebody would go ahead and make that trade? See why that makes sense? It's a good question, though. That's the other thing I want to make sure I'm specific about saying here too, right? That's a very good question, right? That gives you just gave me a really good opportunity to kind of lay all that out and help walk a lot of folks through essentially like my thought process, and likely my guy here. Oh, Simple Rick, come home to $16. Come home to Simple Rick. Yeah, Simple Rick just revising his price target down lower, for the fun of it. Good to see you, my friend. Maybe, Sharon. I mean, I would not necessarily 23. I would say lower bound of 23 for 2 months. But we may get some action around institutional filing around August OPEX. We may get, that may result in something like a $25 test, which will juice up IV decently. But I don't think it's going to stick right on $23 for 2 months. No, just to clarify that. Yeah, well, we could do, so with the cat data, we're seeing that there are errors, which means that there's settlement stuff going on. There's settlement funny business. If you assume that those are, they're market wide, but if you assume that they're mostly errors that have to do with ETF settlement, then you may be able to anticipate using the Bernoulli formula. If it's somebody not, that can just infinitely stuff in the obligations warehouse, then you can anticipate when they might de-internalize that volume by using, Richard calls it T plus 33. The full formula is T plus 6 plus 35 calendar days plus 1 or 4, like plus 4 and or minus 1, something like that, right? There's a T plus 1, but there's a 4-day creation window. Do you include the 1 in the 4-day creation window or not? We're not sure, but it's either T plus 1 or T plus 1 and T plus 4, or it's just T plus 4. But there's some other operative factors going on there, so it's a little tricky to try to guess when that's going to happen. Heather says, thinking we dip more because of the possibility of upcoming swaps. Oh, yeah, that's right. Let me ask some people about that, actually. We might, but we're already very low. I guess we can always go lower, I suppose. They should be like around now. When does Richard have the swap marked? If the swap is still there, like what? I don't know. Are they going to have this open? I think Richard's got it marked for Monday. It's when he thinks there's probably a swap roll. After which maybe we move up a little bit. Little bit. Maybe like up to 25 or something. Early August. And then end of August, he's got another swap. Red Star might be gone, though, end of September. Maybe not, though. Got to watch out for end of August. So maybe a little kind of like mini thing in the middle of August. I think he's what he's looking at. Post FOMC, kind of going into FOMC, maybe. So maybe, but maybe that just comes on Monday, right? We get a little dip-de-doo on Monday. Maybe. It's a good thought. It could, but again, right? It's gonna be how you play it. If you sell a covered call out that far, and you get a volatility pump, price is probably also pumping too. So you're going to be stuck in that call probably for a little bit. And you're probably going to have to wait until the price comes back down, or you get pretty close to expiry. The thing that's nice about a short put is even though you're short volatility, you're also long the stock price. So if volatility comes back right on GME, typically the price goes up. So even though you may be losing on the volatility bet, you're winning on the stock price bet. So you're not stuck in that thing. You can take profits if you mistime the volatility spike. The call, if you sell that too far out, you could mistime a volatility spike, get caught, and then get stuck and just have to sit on that. That's the difference. And then if you sit on it, then it's not like you could realize profit from the underlying shares anyway, because you'd have to wait for it to come back down, or at least wait for it to get pretty close to closing out of the money. Maybe your shares will still be higher at that point, but yeah, Shinsatsu makes a good point here. How do you know it will be higher? Yeah, we might not. That's pretty cool that it's there though, because that's also going to be right after FOMC. Into a weekly OPEX though. Maybe. Would I make the large spike of count hours and options now as opposed to equities like we've previously seen? Yeah, I remember reaching formal on that. I think his observed trend was that cat options errors typically correspond with bearish price movement in GME in the 35 to 70 days following over a certain amount. Whereas for equities errors, it's going back to the upside. Why is that bearish? I don't know why that would be. I have to put some thought to that. But if it's probably like this. Equities errors, I think, typically occur at a time when the stock is moving down, and the cat error the report that records them happens enough time out from when the errors were committed that the 35 to 70 days following the original element ends up being in the midst of a price up cycle. Options errors occur toward the top of a cycle, or maybe closer to the top of a cycle, or coming off one, something like that. And so there ends up being issues with option settlement due to high volumes during high volatility periods. And so the 35 to 70 days following high options errors comes as a result, or is associated with then, okay, within the next 35 to 70 days, you're going down, right? Because you just had a really high volatility period. It could just be as simple as that, right? Just equity high options errors are typically associated with high volatility, because that's when the options are most in demand, and there can be settlement problems. Something like that. GameSpot buy shares to hold for the bond offerings. Oh, what just happened? Oh. Well, my phone just... All right. Well, I hope you folks can still hear me. Yeah, it's very hot in this apartment. Like I said, I don't have any air conditioning. Yeah, my camera just overheated. So my phone is now overheated. I will have to go put it in the refrigerator. I should be able to switch to my integrated camera now. Now I look homeless, but yeah. But that's probably, yeah. I gotta put the phone in the fridge, dog. It's dying. It's so hot. It's so hot. It's like, yeah. I think it's telling me it's overheated too, right? Yeah. Yeah. But that is probably a good place for us, I think. I think to pause for today. This is a really excellent stream as always, guys. It was really great to see you. Very glad to have resolved this issue. Mostly, I still have to do some weird cockamamie stuff to, with doing an incognito browser tab to get my camera to work. I don't know why that's happening. But it is working now, which is great. Hopefully I can find a way to get that back and normally working. It's a browser. It's still a browser integration issue, but it worked here. So, very good. So yeah, I mean, even though, right, we don't get a lot of exciting stuff during the day necessarily, right, doesn't mean we can't have profitable months. It doesn't mean we can't have profitable trading days. Doesn't, of course, doesn't mean that we don't have stuff here to talk about. So just want to thank you guys once again. Thank you guys so much again for your patience last week. Been on the road here. I know some of my videos, doing one from, the business lounge of Zurich, whatever, Swiss Airlines, and then getting some videos during the conference here, and of course now in my extremely warm French apartment. But just want to thank you guys. Look forward to seeing you. Next week. I will try my best to get all the material up in timely order. Should be able to get the weekly things. I think we will not do a live stream next week. Next Sunday, a week from Sunday, I am getting married. So I'll have a lot of family in town for the weekend, and I think it's going to be difficult for me to get the live stream up. We'll definitely want to be spending some time with them. So we'll see if I can squeeze it in, but I think we'll more or less end up postponing that out a week. So yeah. Cheers, man. Thank you, guys. Thank you. Thank you. Thank you. Yep. So yeah, we'll see you at this week's videos. Obviously, feel free to comment on. Yeah. Thank you guys. For reach out, send me a message, comment, whatever you like. Um, I'm sure. I don't imagine things are going to get too hectic next week, but always happy to hear from you. And yeah, we'll see you guys. We'll see you guys at videos next week, and we'll be back to the live stream the week after. So yeah, have a great weekend, everybody, and we'll see you next time.